First off, thank you all for joining. This is Mike Shillin, President at Shillin Wealth Management. I'm also joined by Jake, our Vice President. We're very, very lucky today to have two guests join us all the way from the East Coast, assuming that's where you guys are holding up in quarantine right now. I had the pleasure of meeting Howard and Robert last November when I was in New York City on a business trip, and they really opened my eyes to a new way of investing. ESG investing has become a pretty popular trend in our industry, but what I love about Howard and Robert is they actually talk the talk and walk the walk. Our goal today is to learn a little bit more about what impact in ESG investing is. Howard's going to share some of his experiences as well, and we're also going to just talk about how the Atlas Fund actually accomplishes these goals. So with that, I'm going to turn this over to you, gentlemen. We will do a question and answer session at the end. For those of you who are on Zoom, there is a chat window. So if you have any particular questions, please just send the questions to Jake and I, and we can make sure that Robert, you're hosting, so the questions would come directly to you, correct?
Well, we'll all see the questions if they come in through the chat, as long as you have it open.
Perfect. So with that, I'm going to turn it over to you, Robert and Howard.
So I want to thank Mike for doing this. I got to know Mike a little over a year ago when my son Harrison merged his advisory practice into his, and Mike has become a trusted advisor. He serves my wife, myself, my mother, one of my other sons, and we've really enjoyed getting to know him and learning about his outlook on the world, and then sharing with him the work of Gratitude Railroad. Gratitude Railroad is a business that I started about 7 years ago with a very dear friend, with the idea that capitalism is a solution to most of mankind's problems. We can talk about impact investing. We can talk about ESG. I tend to think that impact is a sort of a touch further along the curve in focusing on businesses whose product or services benefit mankind or the planet. And as my partner and I learned about impact investing, there are a few things that we saw were lacking. One was the actual movement of capital. So what makes Gratitude Railroad different from most entities in the space is that when we share something with our community, and just like you're a community amongst the friends and clients of Shillin, we're a community of investors, of entrepreneurs, of founders, of academics, but importantly, the core group of us who make investments, when we invest alongside the people that we are asking to invest as well. So as part of the work, one of the things that became very important to me and apparent to me was we needed a way to invest in public equities in the same way that we do in private equity or venture capital. And there was no real fund that attacked the public equity world with the same kind of thesis that Atlas Impact does today. So we set about finding the right team, finding the right thesis, and helping to create the structure of the fund, which after 4 or 5 years finally came together last May with Rob and his two partners, David Castricone and David Lois. They're an incredibly talented team. They have great experience. They bring the same kind of values and ethos that Gratitude Railroad brings to all the work that it does in impact investing. And as I said, we invest in it. Up until this morning, I was the largest investor in Rob's fund. He picked up a new investor this morning who will supplant me, which is great. I couldn't be happier for it. And as you may have seen in my resume, I run a hedge fund business by day. And the only investment that I have that's the second biggest investment I have is my investment in Atlas Impact. I would love, we have short time today. If anybody has questions or wants to learn more about impact investing, I'm happy to share more about that, with Mike. But when we turn it over to Rob, we love questions, but I can talk to Rob all day long. So if you don't have any questions, I'll be sure to torture Rob enough. Go ahead, Rob.
What I thought might be helpful this morning is to just talk a little bit about impact investing itself, how we define it at our firm, and then how we execute on that. It may also be helpful to give you a little bit of context about our performance this year, because I think it's been pretty strong. The punchline I'll give you right now is we've been up around 14% year to date. And a lot of that has to do with the issues that Howard pointed out, the fact that we are a long-short hedge fund. But what I really want to do is make sure this is as useful to everybody as possible. So please think about questions that might be relevant for you, and I'd be happy to address them. So let me first start by just defining for you what we think impact investing is, because there is a spectrum of what you might call socially conscious investing, or doing good, or double bottom line investing, or triple bottom line investing. We think of investing in companies that are doing something through their product or service to either create a solution to a problem in the world, or on the short side of our book, which is where we hope to profit from companies by shorting their stock, and then when the stock price goes down, making money. We tend to think of things that are doing harm to the world. And we have 6 thematic areas that we focus on. And those thematic areas are largely aligned with the United Nations Sustainable Development Goals, and that's intentional. But they are themes that we call enabling environmental solutions, unique solutions for healthy and productive life, modernizing capital and industrial infrastructure, a sustainable food system, financial services as a force for good, and harnessing beneficial digitization. We think of those 6 thematic areas as defined by the product or service that a company sells to the world. So for example, we would want to own a company that makes a solar inverter, right? That's the piece of power electronics that converts unstable sunlight into stable AC current. We would want to own in our portfolio a geothermal energy utility. We might want to own a company that is developing a very specific drug protocol to help previously unserved populations. And I want to be careful. We're very clear about how we invest in healthcare. It's not in big cap pharma. And then on the short side of our book, we think about shorting companies that are doing something to harm the world. So we would think of shorting a company that makes diesel engines for marine transportation. We might think about shorting a company that is extremely polluting in its production processes of the products or services that they deliver to the world. And what we do is we start by asking the question of the roughly 4,800 companies in developed Europe and in the United States and Canada. What is the product or service that the company delivers to the world? We immediately get rid of large cap pharma companies, as I said, large cap financial services companies, big conglomerates, because we're not interested in sort of finding out, is Procter & Gamble have a better mix of food products than maybe Unilever? That's not interesting to us. We're very focused on companies that are providing one specific thing to the world, executing on that, and generating at least 80, if not 90 or 100% of their revenues from that one product or service. That gets our cohort down to about 600 companies that we think have the impact that we're looking for in our portfolio. And then from that 600 companies, we then just ask some very fundamental questions about the quality of the business structure, the management team. Do they have a track record of excellence, and do they have a track record of deploying capital carefully and consistently over time for a strong shareholder return? And on the short side of the book, we're looking for things that are exactly the opposite. And that gets us down to a group of companies that's about 225. And from that point, we really just start to look like very rigorous, fundamental, bottoms-up stock pickers, where we're trying to construct a portfolio of stocks on the long side that are going to deliver exceptional returns, and a portfolio of stocks on the short side that are going to deliver exceptional returns to our investors. And in doing so, what we come up with is a group of about 55 companies, roughly 30 short and 25 long, that are generating returns for our clients over time. And we do that by estimating what we think over a full cycle of the economy and a full cycle of business for this company, what we think their stable earnings power is. We then discount that back to today, and we literally come up with a valuation for the company. And if we're different than the market, it's an opportunity for us to make money for our investors. I do want to say one brief comment about our portfolio process, which is that we don't believe at all that owning something just because it's going to go up or shorting something just because it's going to go down is the right way to invest. We actually believe that we have to have what we call a variant view, which is an understanding variant to the marketplace, right? Why do we think our view is different? It's always based on evidence. It's always based on deep fundamental research about the company, about the markets that it's in. We do channel checks. We talk to management teams fairly consistently. We want to understand where are we going to be right and where are we going to be wrong, and what are the signposts that we believe are important for confirming that our view is right. So we want a variant view, we want evidence, and then we want to know that there's a catalyst. What event is there out on the horizon that is going to make the market aware that this company is worth more than the current stock price? And then finally, we always want to know what's our level of conviction? How much confidence do we have in our own view? And then how much do we believe that this view is going to come to truth? And those four things, VECC, what we call VEC, defines every company in our portfolio. And the reason we're so insistent on that is because if you don't understand why you think you're going to be right, in our view, chances are you're going to be wrong. And it also allows us to understand very clearly, like we did during certain points of time in February, March, and April, that if a share price of a stock is declining dramatically, maybe it's just declining dramatically because people don't like it and they don't understand it, and maybe we should buy more. Or similarly, if a stock is rising pretty aggressively, maybe there's a reason we should be shorting more of it right now, even though the market consensus is different than what we are. I guess the big picture takeaway I want you to have there is that we're very rigorous, fundamental, deep fundamental investors who really care passionately about sort of the work that we're doing. With that said, I also wanted to give you a sense of who the team is, because I think that's fairly important. So we are three partners who came together really explicitly for this purpose. What you'll see in the world of impact investing sometimes is a company that was doing something different before, and I think Howard referenced this, and now they've decided, oh, we want to get on this impact bandwagon. We want to get on this ESG bandwagon, so let's change our process a little bit. Other times you get people who are passionate policy people, right, who really firmly believe in a certain set of issues and believe that they should be an investor in those issues. We think both of those are noble causes, but neither one of them really gets to the heart of the matter, which is you've got to have a passion for the underlying fundamental work, and you've got to have a passion for the idea that you're doing something to change the world with your capital. And if you look at the backgrounds that the three of the founding partners have, first of all, my partner, Dave Loesch, was at Goldman Sachs Asset Management for 10 years, working for a guy named David Blood, who was the head of Goldman Sachs Asset Management. And David Blood left to found a firm called Generation Investment Management. Generation was founded by David Blood and Vice President Al Gore. And together they have built a firm that most people would say is the single largest and potentially probably most successful sustainable investing firm around. My partner, Dave Loesch, joined them very early on and then went on to be a partner and a portfolio manager at that firm. My partner, Dave Castricone, has spent his entire career investing in healthcare stocks. And as I alluded to earlier, his passion is for very specific healthcare companies that are doing something to better the world by bringing either a protocol or bringing a specific drug to market that is changing a very specific behavior within the human body or resolving a very specific problem within the human body, typically for undersolved problems in underserved populations. And then I spent my entire life either as an economist working for firms like Morgan Stanley and AllianceBernstein, or more recently, I worked for a guy named Paul Tudor Jones when I helped him create an organization called Just Capital, which is essentially an ESG ratings platform, a company that, an organization that looks at the environmental, social, and governance issues related to a company's operations, and then asks the question, how good is this company based on those factors? Paul had hired me as the head of research to build out that platform, the footprint, and the team. I did so before launching Atlas Impact Partners, which of course is what we're talking about today.
Right.
So that's sort of us in a nutshell. I wanted to pause there for a second, see, Howard, if there's a certain direction you want to
Yeah, just let me add a couple of points. First of all, just remind everybody that the chat is there. I'm the only person who puts something in it, which is there are no dumb questions. You feel free to just jump in verbally if you prefer not to use the chat. I think there are a couple of things that are really important here. One is the idea that the kinds of companies that Atlas is investing in are the kinds of companies that are going to address the challenges facing mankind and the planet today. Things that will benefit from the change in our energy systems, our food systems, our manufacturing systems, and at the same time going short those companies that will not benefit from that. And what's really important about this, and something that was something that I theorized about as I shared the story of Atlas before this year, was that by combining the long strategy with the short strategy creates an incredible opportunity to protect the downside. And that's one thing that many investors are not familiar with. And the thesis is, if we believe, or we know that the climate is changing and that we're transitioning from a fossil fuel-based energy system to a non-fossil fuel-based energy system, if you invest on the long side of that, you're going to make money as we move to solar and wind and everything else. And you're going to make money if you sell short the coal industry or something like that. And those, to some extent, work together. But in challenging, highly volatile market environments, to some extent, the fundamentals apply a little bit less, and the market actions become dominant in the process. So Atlas made money in March when the markets were devastated. I think that's a really important part of this. And also another important part of this to me is we can talk about ESG and it sounds wonderful and it sounds beneficial, and the ESG funds have mostly outperformed the broader equity indices to date, but it doesn't address the big change issues, and which is why Atlas has had such a very good and attractive rate of return. And so I think that's important. Other than that, Rob, maybe, I don't say, but let me just see if there's, do you see a question in the chat, Rob? No questions in the chat. You want to talk about a specific position that you think would be interesting right now, maybe something on the long side that's in the portfolio or out of the portfolio that's really applicable to the situation we're facing?
Well, maybe I could describe a few of the sectors, and then I'll gladly talk about some of the positions that we have in the portfolio. We tend to want to, as I said before, own companies that are solving problems in the world. Right now, that is leading us towards a few different ideas. One is, as I referenced, the solar complex, whether it's the solar inverter manufacturers, in one instance, a solar installation company. We believe that those are the higher margin parts of the whole solar industry to be operating in. For example, panel manufacturers are sometimes interesting, but tend to be a pretty low margin, boring business. We're also involved in water engineering companies and wastewater treatment companies, which we think is a very important and underserved part of the engineering space, essentially either ensuring that certain areas of the world have clean water or ensuring that you can deliver that clean water from point A to point B. In the healthcare space, we're invested in several diagnostics companies, one of which has created a liquid biopsy, which is essentially a way of detecting for cancerous tumors within the body by drawing blood. Rather than, for example, taking a piece of someone's liver out and taking someone's, piece of lung out, for example, which is a highly invasive and sometimes unproductive way of gathering information about cancerous tumors. This company that we own has developed a technology to draw blood, examine particles of the tumorous cells that have been shed into the bloodstream, and then examining the DNA of those blood cells, shed tumors in the blood, and then identifying whether or not the cancerous tumor actually exists or has been progressing. And we think that's an enormously powerful procedure, not only because it helps the identification of tumorous bodies sooner, but it also helps ongoing analysis of the tumors, because what it does is it allows you to more frequently assess what's going on in the body rather than going in, every 6 months and potentially taking part of the tumor out. And then on the short side of the book, we are short, hoping to profit from a decline in the price of stocks in the munitions business, some stocks that are, as I referenced before, creating diesel engines either for industrial use or for marine use. And we've got several short positions in companies that we believe are lending egregiously to borrowers who are in compromised financial situations. So think of a company that is providing lending services to low-income borrowers who are buying used automobiles. Frankly, in our mind, we can't think of a more egregious way to treat someone than to overcharge them for an asset that's declining in value towards zero. So those are some of the kinds of companies that are in our portfolio. I think, Howard, to your point about, making money in a challenging environment, I think it's maybe helpful to just highlight that during this crisis, the way we made money was really twofold. One was we believed very early on that the U.S. economy, and this goes back to January, that the U.S. economy was in a tenuous position, largely because we just didn't think the consumer was going to be as strong as many of the pundits thought that the consumer would. In other words, the consumer wasn't going to bail out a weak manufacturing sector. But then going into the crisis, what we saw was the capital markets start to seize up reasonably quickly. And what that forced us to do is take down the risk in our portfolio and concentrate the risk that we had in those companies where we had done an enormous amount of work to understand how tenuous of a financial position they were in or how strong they were in. So we were doing a lot of work to look at the leverage that companies had on their balance sheets, the debt covenants that they had with the banks to see if they were at risk or if they were able to draw down their facilities. And then we were looking very carefully at how they had historically deployed capital during crisis situations. And what that led us to was an understanding of where our strongest, highest conviction positions were. So we took down our risk, but at the same time concentrated what risk we were taking in those companies that we felt either had the best position to survive going forward, or on the short side of the book, those companies that we thought were most close to failure. And that was one of the reasons that we were able to generate a reasonably good return during the months, particularly of February, March, and April, where we were up net of fees. We were up 170 basis points in February, 130 in March, and in April, we were up around 6%.
Hey, Rob, there's
Yes,
a question in the chat, which I think would be a good overall topic. The question was, how much of the book is long and how much is short? Maybe you want to explain net and gross and how you move between those factors and how investors should look at that.
Sure. That's a great question, Howard. Thank you. So when we're constructing our portfolio, we are what one would characterize as a low net long short fund. So we want to have roughly the same amount of long positions in our portfolio as we have short positions. And what that does is two things. One, it reduces our exposure to the overall broad trends in the market, right? Because as the market is rising, we tend to be making money on our long positions and losing a little money on our short positions. At the same time, if the market falls, we're making money on our short positions and losing money on our long positions. Now, that balance that you would call a low net fund also means a second thing, which is that the stock return in our portfolio is what dominates the overall return. So we tend to want to own companies, not because they're related to the market, but we want to own companies because we think fundamentally they're very strong and misunderstood, or very weak and misunderstood. It's what we in the business call idiosyncratic risk. We want the stock return, stock by stock, to dominate how we're making money for you as investors. So that's the first important thing, is that we tend to have a low net position, which was very constructive during this crisis. The second thing that Howard referenced is our gross position. So how much leverage do we have in the portfolio? And again, we tend to be fairly conservative there. We tend to want to have the total of our long value and our short value be somewhere between 150% and 200% of the total capital that we have, which in the hedge fund world is a very modest, very conservative world. And those two triggers, those two levers, both the net position that we have and the gross position that we have, are levers that give us an opportunity to manage our risk during a crisis situation. So as Howard referenced, during this recent crisis, when the market was declining pretty rapidly, we were able to adjust more into short positions, and we were able to take down our overall gross position, which limited our risk as the markets were behaving very violently and very with a lot of volatility.
Hey, Rob, another question that's come up. There's, first of all, maybe explain a little bit about ESG. While, I consider it somewhat of like a milquetoast kind of strategy. So how do you look at the kinds of companies you invest in that really address these issues? And also specifically, have you seen anything in the circular economy, sustainable fashion, and things like that as well? Yeah. But let's start with the big picture, impact versus ESG, and how you incorporate it and where you do going more in depth.
Sure. So the first thing I want to say is that if an investor is dedicating their capital in an authentic way with rigor, there's lots of room for different kinds of strategies. But as Howard said, an ESG strategy, which is a way of thinking about a company based on the way it behaves. How does the company's process affect the environment as they're manufacturing things, or if they're a services company, as they're consuming a lot of electricity in a warehouse? What's the environmental footprint of that company? What is the social good that company is doing? How does it treat its workers? How does it treat its shareholders? And how does it treat the people who are, let's say, around their factory or around the wastewater treatment plant that they might be operating? That's the S. And then G is, how well does this company govern itself? What's the governance structure? Does it have an independent board of directors? Does the chief executive officer have total control over the company, as is the case with some founders who become CEO? Or is there broad dispersion of power within the company and across the board? Those three things, environmental, social, and governance, are what we mean by ESG. And it's largely a view on how the company operates, how it behaves in the world. And frankly, we do think that as investors dedicated to a mission that is about finding companies that are doing something good for the world, I do tend to think that that's a little lightweight. Because you start to get into questions of, is ExxonMobil better for the world than British Petroleum, because ExxonMobil has more shareholders, more employees that are being treated well. Frankly, our view is that both of those companies are pulling carbon out of the ground and burning it and polluting the environment and creating emissions that are harmful. It doesn't matter necessarily how they treat their employees. What matters most is what their product is doing, which is polluting to the world. And that's why we ascribe to an impact view of the world. We really want to know, what does that product or service itself do? We want to know, for example, not that Pepsi has a very clear commitment to gender diversity, which, by the way, we think is extremely important and support. But we'd look at Pepsi and we'd say, well, that's great that they're committed to gender diversity. They also happen to be creating a product that causes diabetes in children. and creating food products that are unhealthy for human consumption. That to us is more important. It's the impact of what the product or service does to the world that we think is dominant. And that's a view that we express across our entire portfolio. Of course, on the short side of the book, what we're looking for is companies that are doing something through their product or service to harm the world. Regarding that second question there, Howard, I think
it's about sustainable fashion.
Yeah.
Circular manufacturing, or anything in the portfolio that's in that range.
So we do believe in the recycling economy. However, most of the companies, particularly in the fashion space, that you would want to own and think about are not listed companies. They tend to be much smaller. And we are restricted by our mandate to invest only in stocks that are traded on exchanges. We do believe that there are some recycling companies, particularly in Scandinavia, that have created technologies for recycling plastics more efficiently. You think about the company that takes that bottle at the store and spins around the bottle and then gives you a voucher for a nickel back at the cash register in the supermarket. That's a company that we think is extremely important in the recycling economy. Water recycling we think is extremely important. And there are lots of different ways to play that. But I will say in terms of fashion, as much as we support that tends not to be an area where we can invest just simply because those sorts of companies aren't publicly listed.
So Rob, in addition to healthcare and pharmaceuticals and energy systems, what other sectors do you have exposures to on the long and the short side?
So let me just pull that up for you. Yeah. So I would say right now, and I'll talk about this in terms of our long book and our short book. In addition to call it healthcare, which is typically about a quarter of our book. New industrials, which would include alternative energy and would also include what we characterize as clean infrastructure. That's about 15% of our book. We've got several positions in companies that we believe are serving human health and wellness. Think of companies like Planet Fitness and Weight Watchers. And then some old school, what you might think of as old school industrial companies, but that we think are doing a lot to improve the world through train transportation, which is a very efficient mode of shipping goods and people, particularly in Europe. And then and we've also got a long positions in two food companies. One of which that I'm sure you've heard of that is creating plant-based meat that we think are pretty interesting. And then on the short side of our book, in addition to the company that I referenced before in the consumer finance space, we've got several consumer finance companies that are providing levered capacity or short-term borrowing to people buying things like furniture and TVs, what you might call a payday lender, which we think is pretty egregious behavior because the stores tend to sell things to people, let's say a sofa for $350 and they wind up paying $900 for it once they're done paying interest and fees. We've got some short positions in the auto sector and in the auto leasing sector. You think about rental car companies and two companies that are in the REIT space that are, we think, capitalizing on low-income housing in a way that's pretty egregious.
Okay. If anybody has any questions and you can't get into the chat, please unmute yourself. Rob, maybe you want to comment on the macro, right? Everybody's wondering, is the market cheap or is rich? Why have we made such a recovery and how does that apply to all the factors that have brought us here? And how is that impacting your exposures?
Yeah, it's definitely impacting our exposures. The first thing I would say or reiterate is what I said earlier, which was coming into this crisis, we did believe that the consumer had basically been tapped out. It's absolutely true that we had a very strong jobs market, but we had started to see the acceleration of the jobs market slow down, and we had started to see personal consumption expenditures slow down dramatically from an average growth rate of something like 3% to about 1% a year. You just can't save, the $20 trillion economy off the back of that kind of consumption growth. Now that we're through the cycle, there are a few very important things to us that are going on. First of all, the market seems to be looking at growth rates. There's no doubt that the labor market has accelerated in May. There's no doubt that personal consumption expenditures accelerated in May. But what's more important is to remember that we're accelerating off an extreme bottom. So yes, we've had a tiny uptick, but we are reluctant to call that a V-shaped recovery because the level of consumer spending is still roughly 23% below where it was pre-crisis. And the level of the labor market relative to where it was pre-crisis is still 20 million people short. So yes, we had a reacceleration in jobs hirings, but we still have 19 million people who are unemployed in the United States. Now, what we're thinking of is that what we've had is a recession. We've started to see a recovery, but now not in terms of a V, but think of it in terms of a square root function. We've seen a little mini jump up, and the level of economic output from here forward is going to be highly dependent upon the pace of hiring that we see going forward. Just to give you a sense of why we think that the pace of hiring is going to be so muted, if you divide the labor force into people who work for large companies, medium-sized companies, and small companies, 51% work for large companies. Obviously, 49% then work for small and medium companies. If you assume that 100% of the people who work for large companies are going to be rehired, that 90% of the people who work for medium-sized companies are going to be rehired, and 80% that work for small companies are going to be rehired. What that gets you to is an overall reemployment rate of just 93% pre-crisis, which means we've still got 7% of the labor force that's unemployed. So it's not clear to us that we're going to see over the course of 2020 and 2021 anything that looks like a normal consumption pattern for the U.S. population. The reason that becomes so important is because if you think about where we are in the stock market today, the stock market today is essentially saying that we're about 5% away from the peak that we were at in February. Another way of thinking of that is economic activity and earnings should be roughly 5% less than where they were at the peak. And we just think that there's no way that we get there. So essentially what we've seen is the market get very excited about two things. One, that small rebound in economic activity that I described before. And then two, all the liquidity that the Federal Reserve has provided to the marketplace, which has essentially gone from the banks to shareholders. Neither of those we think are sustainable. The final thing I'll say about our outlook is that we have yet to see a consumer that is absent the stimulus payments that they all received, that many of us received during the crisis. In order for us to match the payments, the consumption pattern that we saw in May and are seeing in June, we're going to need to either see all of that stimulus happen again, or we need to see the consumers or the households' savings rate drop from where it is now back to below where it was pre-crisis, which was about 8%. Consumers, the household savings rate now is about 20%. So for us to see it go from 20% down to less than 8% would be an extremely aggressive move, and it doesn't really seem likely given that people are so uncertain about what the future looks like. So the bottom line is we think that the market is over-discounting recovery and is not considering sufficiently what earnings are going to look like once we get through the summer and we start to see reality hit in the earnings season ahead of us.
Rob, we've got another macro question.
Yeah.
That, I'd like to address in the best way possible. And it relates to, one, the fact that China has stopped taking our recyclables, the impact on the movement towards sustainability and circularity due to the low cost of oil, and the concepts of the externalities that so many companies are involved with, let's call it the fossil fuel companies and the carbon tax. And so maybe your philosophy on that overall, and where and how that might be expressed in the portfolio.
Yeah, we do think that what we're seeing is a shift from, China, and Howard, the person who asked the question is right to point this out, a shift from China accepting recycling materials and reusing them to a more localized recycling economy. Now, that's a longer duration shift that we're going to need to see over the course of time. But it's one of the reasons that we get so excited about localized recycling efforts and companies like Tomra Systems, which is the company I was referencing before, that can help localities collect bottles more efficiently. And we have definitely seen a slowdown in recycling activity overall because China has stopped accepting globally produced plastic waste in particular. Regarding the low cost of oil, I think there's really two things that are important to consider. One is that there is some concern amongst those of us who care about these issues that a low price of oil will slow down the path towards sustainable energy. And while there is a small bit of truth to that, we actually disagree completely for two reasons. One is this year, capital expenditures forecast for the next 3 years, for the first time, are higher in alternative energy than they are in traditional energy extraction, which we think is a very important dynamic that has not been appreciated yet by the marketplace. The second is that the price of energy is in alternative energy at utility scale per kilowatt hour is now roughly parallel, if not cheaper, to traditional forms of energy. And that to us means that the alternative energy movement is going to exist for quite some time. The final thing I'll say is most carbon-based energy is actually used either for the household or for transportation. It's not used in utilities, with the exception of coal. And the important point about coal is once you shut down a coal plant, it becomes too capital intensive to restart it. So just because oil and coal have declined in price doesn't mean we're going to be seeing capacity shift back in there. Along with all of that, what we see, I think more importantly to the question that was asked, is with the decline in oil production, we're going to see a decline in the use of petrochemical produced products and services like plastics. And we'll see an acceleration in the recycling of plastics because somebody's got to pick up that demand or the supply for the demand of feedstock. And recycled feedstock is highly competitive price-wise.
I don't have another question in the chat, Rob, but when you think about what we went through, especially those of us who are professional investors over the past few months, relatively unprecedented. What do you think you learned? What surprised you and what didn't surprise you? And how do you feel you're prepared just in case this happens again, whether, God forbid, it's this year or sometime in the distant future? What surprised us? I think two things surprised us. One is just the speed with which the decline happened. It is, as you pointed out, an unprecedented moment in time. We have never seen, for example, an unemployment rate in the United States that reflected 20 million people out of the workforce. Second thing that surprised us was the market's willingness to believe that is all behind us. This 30% run up in the market in the last 5 weeks to us is shocking and frankly points to a risk reward that is pretty uninteresting
which is, one of the reasons why I would advocate for a long-short strategy right now. You need to be defensive at this moment in time. If you think about where earnings forecasts are, we're basically back to 2016 levels, even though the market valuation is at 2019 peaks. So that to us just doesn't make any sense at all. Those are the two things that have surprised us the most. What have we learned? I think we've learned that sticking to what you know well and staying away from investment situations that you don't understand is, we believe it always has been, but is more important than ever. Really understanding the dynamics of what you own and why you own it has become more important, because the prices in the marketplace today are so volatile. It's really hard to understand valuation. So what you have to understand is value, and they're not the same thing.
Another question. I've asked you this question on a regular basis, and hope you don't mind me asking it again. You've made some interesting macro comments about the marketplace and valuations in the economy. Will you ever go net short? If not, why not?
So we have been net short. We've been as much as 5% net short, and we would again. But right now, I think we've been roughly 5% long to 10% long the market, because despite our belief that the valuation in the marketplace is just exceptionally unreasonable, there's an enormous amount of liquidity out there, and there's an enormous amount of sentiment supporting the market. Fundamentally, we think it's nonsense, but there are moments in time as an investor when you just don't fight the Fed, and this is one of them.
Hey, Rob, Jake, can I jump in here for the question?
Sure.
Please.
Speaking to the long side of the book, I'm curious on the turnover. Obviously, this is an investment. Nobody wants to continue to lose money. So I'm wondering how you balance the wanting to support impact companies for the long term versus whatever their short-term valuation may be. Mm-hmm. You talked about the intrinsic value needing to be different than what the market is currently giving you. So does the short-term valuation have the same type of decision-making process on the long side as it does on the short side?
Jake, that's a great question, and it really gets to the heart of how we think about managing risk in the portfolio. So as you said, we do have a valuation target for every company in our book, and we do a lot of deep fundamental work to understand not what's the price of the stock supposed to be, but just what is this company worth, right? And then it's a simple math problem to figure out what the stock price should be. But we want to know what's the company worth. And in doing so, we get a pretty clear understanding of that company and what's going to drive the performance over time. Now, we do have a price target based on that company valuation. So once we understand what the price target is, if we are approaching that price target, we're going to do one of two things. If the price of the stock, and this is just a risk control that we impose on ourselves, if the price of the stock moves by 10%, we automatically re-underwrite the position and ask ourselves, do we still believe the thesis? If the company reaches its price target, we reevaluate the thesis again, and we will most likely start trimming that position because the risk reward has pivoted away from us. We may actually exit the position entirely. But getting back to the reason we were in it in the first place, we did a huge amount of fundamental work. We will most likely get re-involved in that company once we understand that the price relative to our earnings expectations, our valuation expectation, has come back in line. In other words, there's more money for our investors to be made. To your question, Jake, about turnover, what that means is the name turnover in our portfolio tends to be fairly low. So we tend to, we've got roughly 125 names that we are very deeply involved with and understand very well. But the stock turnover in the portfolio could be high at times because we're going to manage our risk very carefully. We also have very tight position limits on ourselves. We'll never own more than 8% of 8% on a long side and 6% on the short side. Frankly, our positions tend to be a lot smaller than that. But we always want to be disciplined about how we're taking risk. And what that leads to is a higher stock turnover in the portfolio. So we think about it those two ways, right? What's the name turnover, which is fairly low? And then what's the stock turnover, which can be a little bit higher?
Thank you. I don't see any other questions here, and I know we're getting to the top of the hour, so I want to be respectful of everybody's time here. So if I could kind of close with questions for both you, Rob, and Howard. What was the jumping off point for both of you, where you went from being a concerned citizen to actually wanting to start the fund and take action?
That's a good question.
You want to go first, Rob? You want me to go first?
Go ahead, Howard. I like hearing you.
No, I'm kidding. That's an interesting question, Mike. It's been a long journey. I've been a professional investor for over 35 years, focused exclusively on maximizing the return for my clients. I took effectively a sabbatical in 2013 and went back to school with the idea I wanted to learn more about the environment, the environmental crises facing the planet. And I realized at that time that, I spent 35 years just investing, and that was the greatest skill that I could bring to it. And I began to learn about this field of impact investing. As I stated at the beginning, there were a lot of people out there thinking about it, talking about it, but not really doing anything. So to be sort of, very open and sharing, myself and my co-founder thought we could bring effectively a Wall Street attitude to the concept of investing with impact and mission and purpose, and create vehicles like Atlas that will appeal to a wide range of investors, yet still serve the needs. And what I've witnessed over the last 7 years that I've been doing this, just as Atlas has had an outstanding rate of return for its clients in 2020, all the investments that I can't say all of it, but the investments that I've made in this field, that they make me feel good. They're great and interesting to talk about. They have made great strides. And with the world we're in today, with the issues around social unrest and Black Lives Matter and pandemics and sort of the underclass and how we make the world a better place, these businesses are doing very well. They're the businesses that will solve the problems that have caused us all to be at home for an extended time period. And so to think about investing as opposed to against what's in the best interest of people on the planet, investing in concert with what serves mankind and the planet, it's just incredibly logical to me. And it feels good and it's fun and it's interesting. The people you meet are wonderful and interesting. And so it just sort of fits so naturally within everything that I experienced and learned over the years as, let's say, a more conventional investor. So I'm moving everything I have into this kind of investing over the next few years.
So thanks, Howard. For me, I have to be honest, it started, way before I was ever an investor. My parents had always taught us that if you do one thing in this world before you leave, you should make it better. Find a way to make it better. And my mother used to do silly things like when we would leave a campsite, she would tell us to pick up the trash. And of course, when you're a little kid, you say to your mother, well, it's not my trash, I'm not picking it up. And she would always say, well, you were here, so it's your trash now. And stuff like that really sticks with you. And as I was pursuing my career, there was always this nagging sense in my mind that as passionate as I was about the work, that there was this disconnect between, sort of working at a big firm like Morgan Stanley, working at a big firm like AllianceBernstein, working there and doing what I believed was really good work, was sort of disconnected from some of the passions that I had outside of work. And I started to get involved in impact investing probably around 2012, at the height of the crisis, where I just started to think there's got to be a better way to do something with the skills that I have. And at that time, it was just sort of, some private equity investments that I had made personally. And it wasn't until I had started to do the deep work at Just Capital and understand how to really evaluate a company clearly from a different perspective, that I realized I could connect my passions for the work that I do and my passions for helping to change things in the world and bring them together. And that's when Howard and I put our heads together and said, okay, how do we make this happen, right? What kind of fund structure could we create authentically and in a disciplined fashion to make investments or to short companies at a period in time when certain companies are doing good things for the world and certain companies are doing something to harm the world. So it was sort of an organic, natural process for me to get from, my professional skill set and my personal passions and philosophies and sort of merge them together and bring them together. And here we are.
I appreciate that. Those are both really good answers. Anything on your end here, Mike, before we wrap up?
No, I'm proud to be able to partner with these guys. We do have access to the Atlas Fund now on our platform. So if people are interested in learning more about it or learning more about impact investing in general, I know both of these guys would be happy to hop on a call with you. Just very happy to have them in our corner. I think this is going to continue to be a big theme as we move forward in the investment world. And I think we've got the best guys in the industry in our corner.
And Mike, thank you so much. We
Thank
appreciate
you,
your
Mike.
support, your interest, and look forward to working with you and your clients.
We certainly do.
All right.
Yeah. Well, thank you, everybody. We hope you all have a happy 4th of July holiday. Stay safe.
You all too.
Thank
Bye-bye.
you. And thank you all for listening. We appreciate it.